Today's market is changing dramatically. If you're just getting into real estate right now, or if you've been crushing it for years, let's say that you're a house flipper like myself. I flipped over 600 homes, but if I was starting out today, I would be very concerned with what's going on in the real estate market. In fact, I am very concerned with what's going on in the real estate market. Do I keep buying? Do I change my strategies? Do I stop buying completely? These are the questions most of us are asking ourselves right now. So I've started real estate investing back in 2005 as a wholesaler. I've seen the market go down in 2008. I got heavily involved in real estate again in 2011. And in the last decade, I've seen a lot of up. But what's happening in 2022 is dramatically changing a lot of my thinking and probably your thinking about the real estate investment business just to begin with. So if you're flipping houses like I am, or if you're doing the BRRRR strategy, buy, rehab, rent, refinance, repeat, we might need to adjust our buying criteria and how we look at real estate altogether in order to adjust for today's market. So let's go over 6 strategies that I'm changing in my business today to hopefully help you guys mitigate risk in your real estate business. Because the number one rule as a real estate investor is don't lose money. So with these 6 steps that I'm going to take in my business, hopefully they help you with your business. So maybe you could avoid that dreaded losing money. But also, if the market doesn't dramatically change like some of us might think, then maybe you could take advantage of what might happen in the future of real estate. So let's go over this right now. All right, so if you guys don't know, I'm Tarl Yarber with Fixated Real Estate. As I've said, I've been investing for quite some time. I've seen a down market. Today's market, nobody has ever seen before. And if they're an expert on YouTube or videos everywhere or Instagram telling you otherwise that they're an expert, they know exactly where the things are headed, they're probably full of BS because none of us have seen that. That said, we got to mitigate our risk. And here's the 6 steps that I'm taking in my business today that hopefully you guys can learn something from. First thing that we're doing is we're adjusting our buying analysis. So how we analyze our deals are changing just ever so slightly. In the past, we focused heavily on just comparables, sold comps. Now, comps are basically properties that are like kind to the property that you're buying, right, or the property you're analyzing in 2 different ways. The as-is value, as is, which is the property I'm buying is a POS. I'm not going to tell you what that actually means, but POS, and it needs to be completely fixed up because it's destroyed. So an as-is comparable would be another POS house just like it that has the same bedroom count, square footage, or whatever that's sold sometime in the last few months. Preferably you have multiple houses like that so you can get a good basis or good strategized guess on what that house might be worth as is. Then there's the ARV, after repair value. Now, ARV is what we're really seeking. If I buy this POS house that needs to be fixed up, I want to know what the after repair value is. Now, in the past, over the last decade, we've been very easily able to take lots of comparables for sold comps on houses that are fixed up at the after repair value that we're seeking for this property. So if there's 3 or 4 properties within a quarter mile or half a mile radius of the house I'm buying that's going to be similar to what I'm going to fix this house up as, then that's a good ARV comparable. Now, a lot of times we're only focused on the sold comps, and we'd even go back 3-4 months. Today's change and what we're doing on our analysis is we are looking at closed sales as comps, but only in the last 30 days. Why? Because the market's changing every 30 days. As the rates change, each market is changing as well. Remember, a past video I said, there is no real estate market, there's only real estate markets. So each neighborhood and so forth. I invest heavily in Seattle, Washington. It used to be I could look at a lot of Seattle and get an idea of the area, but now I'm looking at very specific neighborhoods more so than ever. So 30-day comps are more important to me than 3 months ago comps. I'm also looking at pending sales. So properties that were on the market that went pending. So they haven't closed yet, but they're under contract with a buyer from a seller and they're in pending sales. Now, why is that important as well? How many of there are there? What did they list the price at? Did it sit at the market for 6 months and then get a pending sale? Or did it sell right away in 3 days? Those are things I want to look at before they close. I might even have my realtor call those agents that are representing the seller on the pending sale to be able to find out what they're selling the property for. Some agents do that. That's totally fine in my book. And then last but not least, we're looking at active listings that are on the market. How many? So as rates go up in today's market, there will be more Inventory. Supply and demand dictates price. The reason why there'll be more inventory is because more properties will sit on the market a little bit longer. Now, we've been at record low inventory forever. We're not going to be at record high inventory. Trust me, it's going to take some time. But that said, inventory will go up. So if there's too many active properties and active listings on the market in my area, and I want to sell my house fast, I have to adjust my pricing accordingly. So look at those three things. Sold comps within the last 30 days, pending sales, and active listings currently. And we're looking at, now we always looked at those, but we're looking at the active and pendings more so than ever, and not so far long ago sold comps like we used to. So number 2, we're looking at shorter projects. Now I've done projects that take 12 to 18 months, even for large single family flips. We've done some development and so forth. For me, because I don't know where the market's going right now, I'd rather my projects be a little bit shorter term. 3 to 6 months if possible. 6 months is good for me all day. I can make some adjustments. What is it good for you? Maybe you're used to doing 5 or 6 month projects and you might want to adjust to a 3 to 4 month project. Maybe you're used to doing 12-month projects on purpose, let's just say not on mistake, and you want to reduce your time frame maybe to 6 months or less. That's up to you with how you look at it. I think those 6-month increments for me give me enough time to be able to adjust my strategies, maybe cut losses if I have to and so forth on a project if something goes south, right? Or take advantage of the market if there's an opportunity for it as well. The whole point of this, invest in time frames that you can tolerate in today's market based on your risk level and your risk mitigation. That's all we do in this business is mitigate risk, and time is a factor of mitigating risk. Don't forget that you also have things like supply chain issues still. Those still exist, believe it or not. Shut down the economy for 2 years. What do you think happens? Now, that said, we're going to number 3. Narrow margins. Avoid narrow margins as much as possible. Certain markets were allowing you to do an 8 to 10% cash on cash return on single family flips. There's a variety of markets out there that with quick flips, you can go a lower margin on your returns. Now, margin dictates your risk. Rate equals risk in my opinion. So if I have a higher margin, I'm lowering my risk because I got a bigger buffer. If I have a lower margin, then I'm increasing my risk because I don't have as much of a buffer. Now there's other factors that go into margin and buffer and so far, or margin and risk for yourself, such as your skill set, your time on market, how long it takes you guys to rehab a property, how big the project rehab is. Let's just put it this way. If it's a bigger project that takes a lot of construction, you should have a larger margin. Now for me, I used to buy all the time at 15% cash on cash in my market in the Seattle, Tacoma area, and actually a lot of markets that I bought in. I'd sometimes go below 15% cash on a single family flip if I knew I could do the property well, we knew the area really, really well, and we had the good comps, good rehab schedule, and so forth. But in today's market, I'm incrementally getting that back up to 17, 18 to 20+% to be able to create a larger buffer for me in case there's a shift in the market. So avoid narrow margins. That's something we're doing as much as possible right now. So 4, don't chase the market. Now, what do I mean by that? I'm more talking to you aggressive house flippers out there that are buying properties right now, and then you list your house for sale and you put it at the price you aggressively want. Let's say that it comps for $250,000 and you're like, man, I think we could push the market because we've done it before, so we're gonna list it to $255, $260. In my opinion, in today's market, we should probably price it for what we really want to sell it for and maybe let it sit to see how long it takes. Now, that said, don't chase the market. If the market starts to drop, what most of us investors would maybe do is if the market dropped from 250 to 245, well, maybe we wait a little bit and then drop to 246 or 245. And then it drops a little bit more, so we drop it to 243 to 240. And we slowly, incrementally start chasing the market down, right? Almost catching a falling knife. However, this is a real estate business. So if you planned on making all your money that you can ever make on that one deal, then do what you can to maximize it. But from what I've seen in the past, as people chase the market down when their houses are listed, they're going to not get a very good value for the property and they're never going to sell it, or they're not going to sell it for what they think they're going to in the timeline. Just get rid of the property if the market starts to drop. If the market goes from 250 to 245, well, that's okay. Go ahead and drop yours to 240 to 242 and don't chase it down, beat it down, in my opinion. That way you can get rid of it and move on and do better on the next one. Now, if you're gonna lose a little bit of money, that's fine. From my experience too, if my house is the cheapest one on the market, it's probably gonna sell the fastest and maybe go up a little bit more. So watch that, don't chase the market. A lot of people have lost a lot of money chasing the market down. Number 5, this one's easier said than done. Multiple exit strategies. Now, what do I mean by that? A lot of times we might see a single family flip that the only way to make money on it is to rehab it and sell it, to flip it. But what if you could find a property that maybe a little bit more time, a little more strategies that you could look at the property and go, wait, not only can we buy it and flip it, That's exit strategy number one. But we can also maybe keep it and refinance it and rent it out in case something goes wrong. And that's called the BRRRR strategy. So you buy, rehab, rent, refinance, repeat. Maybe instead of doing a higher end maximum sale price rehab on a property, right? Your highest and best use of that property, maybe you could do a lower grade finish, maybe do less rehab to it and not make as much money, but get rid of the property sooner by doing less rehab. That's another strategy besides you got a higher end rehab or a lower end rehab. If there's still margin in both, maybe you can look at both. That's different strategies. You can BRRRR it, which I already said before. Maybe there's a way to split the lot and have an additional unit in the back. Maybe there's some development opportunities. The point is, if you can find a property that has more than one way to disposition it, then you have multiple ways to mitigate risk as well. Like I said, easier said than done, but if you get a little bit pickier in today's market, you're gonna find those deals. And finally, number 6. This one's pretty easy to do, and that's wait. Now, do you have to buy a deal? No, you never lose money on the deal you don't buy, but you also don't make any money on the deal you don't buy too. Now, what I also mean by wait is not wait and see what happens to the market. A lot of people are doing that right now. A lot of people are waiting and seeing what's going on. And they should, if their way that they run their business and mitigate their risk doesn't allow them to take a little bit more risk with the unknown, with what's happening in today's market. But the best thing about real estate is this. Long term, and this is recorded, I'm saying it, long term real estate wins. How long is the question? We don't know how long. In 2009, 2010, you were crazy to be investing in real estate. Now, there's people today that invested heavily in 2009, 2010 that we're looking at them going like, those guys were geniuses. Look at them. But I bet you didn't think that back in 2009, 2010, unless you're one of them. Hindsight's 2020 in this business, big time. So if you bought a property in 2010 and the market, and you didn't actually make your gains on it till 2015, that's a 5-year wait. What if it took 10 years? What if it took 15? The point is, if you can weather the storms on your properties and just wait, you'll be able to make it up later in the long run. There's people that bought high-end properties in 2007, 2008. There's people that bought low-end properties in 2007, 2008 that lost a ton of equity and a ton of value when the market shifted in 08, 09. But it took until 2013, 2014 for a lot of those properties to regain the equal value, maybe in 15, 16 for some of those people. And if they kept them, well, then they benefited long run if they were able to weather the storm. That said, you got to cut your losses if you have to. You got to survive. But in this business, waiting wins. Last but not least, I've never seen a market. This comes from a quote from my good buddy Kim McElroy. I've never seen a market only go up. So will a market shift? Absolutely. Markets shift all the time. It's part of what the industry does. It's part of what real estate investing does. It's part of what stock market and every other type of investments do. They go up, they go down. Is now the time? We don't know. But there's always money to be made in a down market. There's always money to be made in an up market. The choice is yours. How you make your money in this business, whether you take the risk or not, is up to you. Keep learning, keep following people, keep trying to do the best you can to mitigate your own risk. If you want to follow me on Instagram at Tarl Yarber, I put some stuff up there every now and then, but definitely comment, like, subscribe to this video, and make sure you guys follow BiggerPockets, and I'll see you on the next one.